Welcome to the Deep Dive. Today we're tackling the sometimes head-scratching, always fascinating world of cryptocurrencies and decentralized finance.
Yeah, it's a lot to take in sometimes.
Absolutely. And look, you're probably looking to get a solid grip on what's happening here, maybe without needing a PhD in computer science, right?
Exactly.
And that's really what we're aiming for today. We've gathered, well, quite a bit of information, and our mission, let's say, is pretty straightforward. We want to cut through the noise, really understand the core differences between the big players, like Bitcoin and Ethereum.
The heavyweights.
Right. And then try to get our heads around this whole DeFi thing, decentralized finance, what its potential impact could actually be.
And think of this as, your shortcut to being well-informed. By the end of our chat, hopefully, you'll not only know the key distinctions between these technologies, but also maybe understand a bit more why they're causing such a stir, especially in the financial world. We're going to pull out the essential insights from our sources, really focusing on clarity and understanding that bigger picture of decentralized finance.
Okay, sounds good. Let's jump right in then. Maybe start with the origin stories, beginning with Bitcoin.
The original.
Yeah, launched way back in 2009 by the still mysterious Satoshi Nakamoto. It was the very first decentralized digital currency.
And the core idea was, simple but really revolutionary at the time. Peer-to-peer digital cash. No banks, no middlemen needed.
Right, just person to person digitally.
And what's really interesting about Bitcoin's design, I think, is its singular focus. It was designed to be a decentralized form of digital money.
Like you often hear, digital gold.
Exactly. That's the common analogy. And part of that comes down to its monetary policy, this idea of a strictly limited supply.
That's the 21 million Bitcoin cap, right? A key feature.
Absolutely key. It's built right into the code. The scarcity is a big part of that digital gold narrative.
And then there's how transactions actually get confirmed, this process called proof of work.
Right, proof of work, or POW. You can sort of think of it like a complex digital puzzle.
Okay.
Miners use a lot of computing power to solve these puzzles. Solving it lets them validate a block of transactions and add it to the blockchain.
So it's secure, but it takes a lot of energy.
Incredibly secure, yeah. But definitely energy intensive. That's a major characteristic of Bitcoin's design.
Okay, so that's Bitcoin. Now let's fast forward a few years. 2013, Vitalik Buterin comes along, proposes Ethereum. It launches in 2015. And Ethereum, well, it took the basic blockchain idea, but really expanded its purpose, didn't it? Way beyond just digital currency.
That's the crucial shift, really. If Bitcoin is like digital cash, maybe think of Ethereum more like a digital platform, a foundation you can build things on.
Build things. Like what?
Well, its groundbreaking innovation was the idea of smart contracts. These are basically self-executing agreements with the terms written directly into code.
Self-executing. So they just run automatically.
Exactly. Once the conditions are met, the contract executes itself. And this opened up a whole universe of possibilities, much more than just sending and receiving value.
So these smart contracts, they're the engine behind what people call dApps, decentralized applications.
Precisely. They're what allow developers to build all sorts of things on the Ethereum blockchain. New kinds of financial tools, games, social networks, you name it.
Okay, so much broader potential. And what about verifying transactions? Bitcoin uses proof of work. Did Ethereum stick with that?
It started with proof of work, yes, but it underwent a massive change back in 2022. The merge, they called it.
Ah, the merge. I remember hearing about that.
Big deal. It shifted Ethereum from proof of work to proof of stake, or PEPAS.
Proof of stake? How's that different?
Well, instead of miners solving energy-guzzling puzzles in proof of stake, people essentially lock up or stake their own ether, the network's currency. By doing that, they get a chance to validate transactions and create new blocks. It's kind of like putting up a security deposit. It incentivizes good behavior, because if you act maliciously, you could lose your staked ether.
And the main benefits were?
Huge reduction in energy consumption, like massive. And it's designed to make the network more scalable, able to handle more transactions more efficiently.
Right. Scalability is always a big topic. And the evolution doesn't stop there, does it? We're now hearing about something called the Pectra upgrade for Ethereum.
That's right. Building on that move to proof of stake, Pectra is focused on, further enhancing the Ethereum experience.
How so?
A couple of key things. It aims to increase the staking limits, making it easier for more people to participate in securing the network, and also improve transaction speeds, making things faster and smoother for users.
So continued focus on scalability and user experience.
Exactly. Making the whole ecosystem more robust and user-friendly, trying to handle more activity.
Now, we all know crypto markets can be, volatile, ups and downs. But even with that, it seems like Ethereum is still the main hub for these smart contract applications, especially in this DeFi area we're heading towards.
Yeah, despite price fluctuations, it definitely maintains its dominance in the smart contract space. You look at the amount of value locked in DeFi protocols on Ethereum, it's still very significant. It's the foundational layer for a huge amount of activity.
Okay. So if we had to really boil it down, crystallize the key difference between Bitcoin and Ethereum, what would you say it is?
I think the fundamental distinction lies in their primary goals, their core purpose.
Okay.
Bitcoin was designed from the ground up to be a decentralized digital currency and a store of value. Think digital gold, focused on holding and transferring monetary worth peer-to-peer.
Right, secure digital money.
Exactly. Ethereum, on the other hand, it's much more of a flexible, programmable platform.
Yeah.
It provides the infrastructure, the building blocks for this vast array of decentralized applications. Smart contracts are the key enabler there.
So Bitcoin equals focused digital money. Ethereum, versatile platform for apps.
That's a good way to put it. Bitcoin is largely about the transaction of digital value. Ethereum provides the digital foundation for, all sorts of applications, only one of which might be currency-like. Its scope is just broader.
Okay, that definitely paints a clearer picture. And that flexibility you mentioned, Ethereum's programmability, that really sets the stage perfectly for this whole concept of decentralized finance, or DeFi.
Absolutely. It's built on that foundation.
So for someone still trying to sort of wrap their head around it, what is DeFi in simple terms?
Okay, imagine traditional finance. Banks, lending, borrowing, trading stocks, insurance, all that stuff.
Got it.
Now imagine those financial services, but instead of relying on centralized institutions like banks or exchanges, they're built as applications on blockchain networks. Mostly Ethereum, as we said.
And they operate without those central authorities.
Exactly. They use smart contracts to automate everything and operate in a decentralized way. Services like lending, borrowing, trading crypto, it's all run by code.
So instead of applying for a loan at a bank, you might interact with a piece of software on a blockchain platform.
Precisely. That's the core idea. And this whole DeFi world, it relies on a few key components.
Okay, like what?
Well, first, those smart contracts we keep mentioning, they are the absolute backbone. They automate the rules, the transactions, making sure everything happens as programmed without needing a human intermediary to trust.
The automated rulebook. Makes sense.
Then you have the dApps, the decentralized applications. These are basically the websites or mobile apps that you, the user, interact with. They're the front-end interface to the underlying smart contracts.
Okay, the user interface.
Yeah. And then a big piece, especially for trading, is decentralized exchanges, or DEXs. You might have heard names like Uniswap or PancakeSwap.
Right, DEXs. How are they different from, say, using Coinbase or Binance?
The key difference is there's no central company holding your funds or matching buy and sell orders in an order book.
No central order book.
Yeah.
How does trading happen then?
Often, they use something called automated market makers, or AMMs. It's a different model. Instead of matching buyers and sellers directly, users pool their crypto assets together into what are called liquidity pools. And then an algorithm, the AMM, automatically sets the price based on the ratio of assets in that pool.
Okay, so the price is set by the pool's balance, basically.
Kind of like that, yeah. It allows you to trade directly from your own digital wallet, swapping one crypto for another, without ever giving custody to a central exchange. It's peer-to-peer trading, facilitated by the smart contract and the liquidity pool.
Interesting. That's quite different. And beyond just trading, DeFi also covers lending and borrowing, you mentioned.
Oh yeah, big time. Platforms like Aave or Compound, for example, they let you lend out your cryptocurrency to earn interest.
Earn interest on your crypto.
Right. Or you can borrow crypto assets, usually by putting up some other crypto as collateral.
Okay, like a secured loan, but with crypto.
Exactly. And the interest rates, both for lending and borrowing, are typically determined algorithmically, based on supply and demand within the platform. How much is available to lend versus how much people want to borrow.
All run by the smart contracts again?
All run by the smart contracts. And another crucial piece are stablecoins.
Ah, yes, stablecoins,
Yeah.
like DAI or USDC.
Precisely. These are cryptocurrencies designed to maintain a stable value, usually pegged to something like the US dollar. They're super important in DeFi because the crypto market is so volatile.
Right, so they provide a stable medium for transactions or holding value within the DeFi ecosystem.
Exactly. Reduces some of that volatility risk when you're, say, lending or borrowing.
Okay, so we have smart contracts, dApps, DAXs, lending borrowing platforms, stable coins. Quite an ecosystem. If someone actually wants to use a DeFi service, what does that practically look like?
Well, typically you'd start with a digital wallet. Something like MetaMask is very common. It's often a browser extension or a mobile app.
Your crypto wallet.
Right. You connect that wallet to the DeFi platform's website or dApp.
Okay.
Then, let's say you want to lend some crypto or swap one token for another. You'd initiate that transaction through the dApp's interface.
And then the magic happens?
Sort of. That action triggers the relevant smart contract on the blockchain. The contract automatically processes the transaction based on its pre-programmed rules.
No humans involved in the process?
Nope. And the result of that transaction, the swap, the loan being issued, whatever it is, gets recorded permanently and transparently on the blockchain. Anyone can verify it.
Wow. So the whole process is automated, code-driven, transparent, and relies on the user's own wallet.
That's the essence of it. Autonomous operations, really, relying on code and the underlying blockchain.
Okay. So thinking about all that, what are the big advantages? Why are people so excited about DeFi? What makes it potentially transformative?
Well, there are several key benefits people point to. One of the biggest is accessibility. Theoretically, anyone with an internet connection and a digital wallet can access DeFi services. There are no geographic boundaries like with traditional banks, no need for lengthy applications or credit checks in the same way. This could potentially open up financial services to people who are currently underserved or excluded by the traditional system. Financial inclusion is a big theme.
Okay, that's a powerful idea.
What else? Transparency is another big one. Because most DeFi operates on public blockchains, all transactions are recorded publicly. You can audit the flow of funds, see how protocols are operating, at least in theory.
More open than traditional finance, you mean?
Generally, yes. Then there's user control. In DeFi, you typically hold your assets in your own wallet. You're not entrusting them to a bank or a centralized exchange. You retain custody and control, reducing counterparty risk.
So not your keys, not your coins, that whole idea.
That principle is central to DeFi, yeah. And finally, innovation. Because it's built on open source code and permissionless platforms, DeFi fosters incredibly rapid development. New financial products, new mechanisms, new services are constantly emerging. It's a very dynamic space.
Right, it feels like things move very fast there. But of course, it can't all be upsides. With any new frontier technology like this, there must be significant risks and challenges too, right?
Oh, absolutely. It's crucial to understand the risks. Probably the biggest one is smart contract vulnerability.
Bugs in the code.
Exactly. If there's a flaw or an exploit in the smart contract code that runs a DeFi protocol, hackers can potentially drain funds. We've seen many instances of this, leading to huge financial losses. Audits help, but they're not foolproof.
Okay, so code risk is major. What else?
Regulatory uncertainty is a big challenge. DeFi operates globally and decentrally, which makes it really hard for existing financial regulations to apply neatly. Governments are still figuring out how to approach it, and that uncertainty can be risky for users and developers.
Yeah, the rules are still being written, essentially.
Pretty much. Then there's market volatility. We already mentioned crypto prices swing wildly. If you've put up crypto as collateral for a loan in DeFi and the value of that collateral plummets, you could face liquidation. Your collateral gets automatically sold off.
Ouch. So the underlying asset volatility is a risk.
Definitely. And finally, there's user error and complexity. Managing your own private keys, understanding how these protocols work, avoiding phishing scams.
Yeah.
It can be really difficult, especially for newcomers. Losing your keys means losing your funds, period. There's no customer support line to call to get them back.
Right. The responsibility is really on the user.
Very much so. So yeah, while DeFi offers this really exciting vision of a more open, transparent, and accessible financial system, it absolutely comes with significant risks. It requires users to be educated, cautious, and understand what they're getting into, especially as the space is still evolving so rapidly.
Okay, that's a really important balance to strike. It's revolutionary, potentially, but definitely not without its pitfalls. Requires, like you said, eyes wide open.
Exactly. Decentralized, transparent, accessible, those are the promises. But smart contract risk, regulation, volatility, user responsibility, those are the realities you have to navigate.
All right, so let's try and quickly recap the journey we've taken. We started with Bitcoin.
The original digital gold, decentralized currency.
Right. Then we moved to Ethereum.
The versatile, programmable platform. Smart contracts enabling dApps.
And that led us into DeFi.
This whole ecosystem of financial services, lending, borrowing, trading, built on blockchains like Ethereum, aiming for decentralized, automated, and more open alternatives to traditional finance.
Cool. So we see the contrast. Bitcoin focused on being money, Ethereum providing the foundation, and DeFi building complex financial applications on top of that foundation.
Yeah, and it's really Ethereum's flexibility, that programmability from smart contracts, that unlocks the sheer diversity we see in DeFi. Bitcoin's design doesn't lend itself to that in the same way.
Got it. So here's maybe a final thought to leave everyone with, something to chew on.
Okay.
We've talked a lot about decentralization and automation. These principles are core to Bitcoin, core to Ethereum, and fundamental to how DeFi works. So how might these core ideas, decentralization, automation via code, continue to reshape things beyond just finance? What about other areas of technology or even, aspects of society?
That's a great question.
What new possibilities and maybe what new challenges could pop up as these technologies get more mature, more integrated into our everyday lives? It feels like a really fascinating space to watch.
It really does. We've covered a lot, but in many ways, it feels like just the beginning for these concepts.
Absolutely. Well, thanks for taking this deep dive with us today.